tax advice. I'm sure you're all aware. We also just want to point out to you some of OJM's materials that the principals of the firm have co-authored. Lots of books for physicians, our national book for doctors only, and some state-specific books for doctors. At the end of my portion of the webinar, we're going to give you some contact information. We would love to send you a free book if you will contact us and let us know what you'd like or what you're interested in. We'll be happy to ship that off to you. Some of the topics that 2013 tax law. One of the major changes, or some of the major changes, come by way of investment income. We're going to talk about changes to the capital gains tax rates, changes to taxation of dividend income, as well as to passive income. We'll also be discussing deduction and exemption changes. These include the return of the marriage penalty, the phase out of itemized deductions and exemptions, as well as changes to the estate tax exemption. We're going to look at some of President Obama's budget proposals. We'll briefly discuss the budget rule, although that was seemingly voted down yesterday or the day before. We're going to talk about the cap on itemized deductions, the AMT inflation adjustment being made permanent, and decreased corporate tax rates. And then we'd like these increased taxes in 2013. We'll discuss whether it makes sense to accelerate income into 2012. We'll talk about some retirement planning ideas, Roths and 529s, and we'll talk about cash value life insurance. So our first subject is going to be investment income, and I'm sure many of you who are listening this evening probably just mailed your tax returns in or electronically filed them in the last few days. Hopefully it wasn't too painful for you, but for some of you, unfortunately, it probably was. I think this is the time of year where lots of people are looking for ideas on how we minimize taxes for next year. You know, I don't want to write another big check to the IRS on April 15th, 2013. So let's look at what some of the changes to investment in 2013. Capital gains and dividends have some of the biggest changes. For long-term capital gains, rates, which have been at 15% since the 2001 Bush tax cuts took place, are scheduled to go to 20% effective January 1st, 2013. In addition to that, because of the Health Care Reform Act that passed last year, a 3.8% Medicare tax will be added to long-term capital gains for high-income taxpayers. So essentially, that 15% long-term capital gains rate, if you're in the highest tax bracket, will really go up to 23.8%. For dividends, meaning basically dividends on stocks of U.S. corporations, have been taxed at the long-term capital gains rate, so a maximum tax of 15%. Coming January 1st, that qualified dividend rate will no longer be effective. Dividends will again be taxed at ordinary income tax rate, which, if you're in the highest tax bracket, means you're going to pay tax on your dividends of 39.6% instead of that 15% that they have been. In addition, also for dividends, the 3.8% Medicare tax under health care reform will apply. So if you are a single taxpayer whose adjusted gross income is above $200,000, or a married taxpayer whose adjusted gross income is above $250,000, look for your dividends to go from a 15% rate in 2012 to a 43.4% rate in 2013. So based on some of this information, we've got a poll question coming up that we're going to put up on the screen, and we'd like for you to take a look at it and answer the question. So as you can see, I've got the question up there about your investment advisor. Okay, well, thank you for answering our question. So we're going to share with you the results there. 28% said that yes, annually it's discussed. 28% say occasionally they mention. 28% say have never discussed. And another 17% say only when I bring it up. One of the things that we would tell you is certainly given the changes that we're looking at and the increased tax effect on your investment income, you want to be working with an investment advisor who is proactive in giving you advice on the tax impact of your investments, as certainly as a piece of your pie, that can take a big bite out of your investment return. All right. I also want to point out tax-free investments in 2013 become much more attractive again, you know, in considering the returns on tax-free investments. If you're looking at a 43.4% tax rate on your dividend income, tax-frees become, you know, potentially a much better option, or at least a better piece of the mix in your investment portfolio. For passive income, the new 3.8% Medicare tax is going to apply in addition to dividends and capital gains, also to interest income, to rental income, to annuities, royalties, and to flow-through income. On that flow-through income, for instance, if you have a business where you're a partner in a partnership or a shareholder in an S corporation and you don't materially participate in that activity, the income generated from that investment is going to be subject to the additional 3.8% tax in addition to ordinary income tax rates. So again, tax on those types of income, if you're in the top tax bracket, become 43.4%. So let's talk a little bit about who's affected by some of these changes. As we mentioned, single taxpayers with modified adjusted gross income over $200,000 become affected by this in 2013. Married taxpayers with modified HEI over $250,000. So many professionals participating in this webinar tonight are going to be affected by the surtax and by these rate increases. Some pretty phenomenal numbers to consider. The top ordinary tax rate for those that are affected goes from 35% to 43.4%, effectively a 24% tax rate increase. Capital gains rate goes from 15% to 23.8%. That means you're paying an additional 58.6% on capital gains in 2013 versus 2012. In addition, the top dividend rate, this is the most phenomenal of all of these bumps, goes from 15% to 43.4%, a 289% bump in your taxes. And honestly, as much of an increase as that is, while there are certainly some things that we're reading about in the papers, it's not front page news. The estate tax exemption is set to drop from $5 million to $1 million, and an estate tax rate increase of from 35% up to 55%. Again, a 57% bump. All for taxpayers earning more than $250,000 if married or $200,000 if single. So certainly some tax planning is in order for 2013. What's happening to your deductions and exemptions? The marriage penalty returns. What is the marriage penalty? Back before the marriage penalty quote-unquote fix occurred, it was more expensive for a couple to file a married filing joint tax return based on the same income versus 2 single taxpayers with that equivalent income filing 2 single tax returns. The rate brackets were fixed somewhat, and that marriage penalty was taken away. The brackets are set to decrease again or be compacted again in 2013, so marriage penalty relief expires at the end of 2012. Also in 2013, the standard deduction amount is reduced for any of you who don't itemize your deductions, and there are lower tax bracket thresholds in the rate tables. So couples move into that higher rate bracket at a lower income level. The itemized deductions and exemption amounts, again, will be phased out for high-income taxpayers. So if you're a high-income taxpayer and you itemize your deductions, we're going back to the period where itemized deductions are reduced by 3% of the amount by which your adjusted gross income exceeds the threshold. So if you're a high-income earner, you're basically losing 3%, or you're losing some itemized deductions. And this can be up to a maximum of 80% of your itemized deductions. Now, this is totally separate than Obama's budget proposal that would cap the benefit of itemized deductions at 28%. Personal exemptions are also phased out. So we're going to be losing those for high-income taxpayers. Those can go down to 0. We do have a poll up next before. So the question is, how concerned are you about the impact of the 2013 tax changes? All right, thanks for sharing or answering your question. And we'll share those results. Most of you, 64%, say you're very concerned and you need planning advice. 23% say you're extremely concerned and moving to Canada. I think if my husband's on, I know that's what he answered. And 9% say you're marginally concerned, but you feel there's nothing you can do. Well, we're going to show you in a few minutes a few things that you can do to hopefully at least minimize the effects of that. So we will close the poll there. And we're going to talk to you a little bit about the estate tax exemption. I do think of all of the changes that are taking place in 2013, this is probably the most likely to still have some changes legislated in before the end of the year. As legislation stands right now, the estate tax exemption drops from $5 million as it is currently to $1 million January 1st, 2013. The estate tax rate goes from the current 35% rate back up to 55%. In addition to that, and perhaps just as important, the lifetime gift exemption reverts to $1 million. Now, there's been a lot of talk coming out of Washington that maybe the estate tax rates won't drop, the exemption amounts won't drop quite this drastically. There's been a lot of talk of reverting those to the 2009 rate with the $3.5 million exemption. So certainly that's a possibility. We don't know what will happen, but as the law stands today, the state tax exemption amount is going back to $1 million. So estate tax planning is going to become key again if that is what occurs, as most taxpayers, or many taxpayers, certainly professionals and higher income taxpayers, will have estates greater than $1 million. So let's take a look at President Obama's budget proposals. The not so good news, the Buffett Rule, which proposed a 30% minimum tax on millionaires, people with taxable income over $1 million. However, in the last couple of days, the Senate blocked this proposal from going to a full debate and vote, so it's dead for the time being. Cap on itemized deductions. As I mentioned, this is separate from the phase-out of itemized deductions that is due to come back into play on January 1st. What President Obama's budget proposal has in it is a limitation on the value of itemized deductions to 28%. Again, it's the same taxpayers who make above $200,000 or $250,000 who are affected. What does this mean? It means that while you may be in the 39.6% tax bracket, and actually, as we said, paying 43.4% tax on much of your income, you may be only getting deductions valued at 28% for your mortgage interest, your real estate taxes, charitable contributions, and medical expenses. So those have become a little less beneficial to you if this proposal goes into place. What's the better news in President Obama's budget proposal? He is proposing that the AMT, alternative minimum tax inflation adjustment, becomes permanent. Currently, what's been happening is each year at the end of the year, Congress passes legislation for an AMT patch, which indexes the exemption amount for inflation. What this budget proposal would do would allow us to no longer need to rely on end-of-the-year patch legislation. He's also proposing decreased corporate tax rates, reducing the corporate rate from 35% down to 28% with an effective 25% rate for domestic manufacturers, and also imposing a minimum tax on the foreign earnings of multinational corporations. As you know, and this is in the news a lot, lots of the bigger companies pay no U.S. income tax, even though they have corporate earnings. So what are some plans for minimizing the effects of these tax changes, getting your ducks in a row? One thought would be accelerate income. Realize large capital gains in 2012 versus 2013. A capital gain in December of 2012, it's a long-term capital gain, will cost you a 15% tax. In 2013, that tax is going to be 23.8%. So to the extent you are able to time that such that the capital gain occurs in 2012, certainly that can be beneficial. If you have the option of taking a bonus in 2012 versus 2013, take it in 2012 if you're in the top tax brackets. Again, you're going to pay tax at 35% on that bonus versus potentially 43.4%. Cash basis taxpayers may want to delay expenses to 2013. Again, not so much for itemized deductions, but if you've got your own business and you've got expenses in that business that you're going to write off, those expenses increase in value at the higher tax rates. So you may want to delay expenses to 2013. Consider utilizing installment sales in 2013 and beyond in order to spread your income. The thought here is that if you're close to that $250,000 level, where when you go above it, you've got the surtax added to your income. If you're below it, you don't. To the extent you can even out income and not go above the surtax level, that's beneficial. How about some retirement planning thoughts? If you're going to do a Roth conversion, again, do it in 2012 versus 2013 when the tax rates are lower. Plan for your pension and retirement income to help keep you under the threshold. To the extent you can do Roth retirement income or have retirement vehicles like cash value life insurance, to the extent you can take pension and retirement income distributions more evenly, take lower amounts of taxable retirement distributions to keep you under the surtax threshold. Also, maximize the use of high deductible retirement plans like defined benefit plans and deferred comp. So again, if you're looking at those high tax rates in 2013, defined benefit plans where you can get a big write-off becomes much more palatable to you. We've got another poll that we're going to put up really quickly. So when was the last time that you evaluated your retirement planning? Okay, so there are the results. 65% of you evaluated in the last year. That's great to hear. We often have some clients come in to say, you know, I set up a plan, I haven't given it a thought. 13% in the last 5 years, 9% in the last 10, and 13% of you say, I haven't given it a thought. You're not alone out there. We see that plenty of times. So let's talk a little bit for a minute about 529s and tax-free investments. Certainly 529s become more attractive for your college education saving for your children, as the income from those is not included in AGI, and again, helps keep from pushing you above that threshold. Roth conversions are a plus because a Roth IRA has no required minimum distribution, whereas traditional IRA does have that, so you have to start taking the income out at age 70 and a half. Municipal interest is more attractive as there's no addition to that modified AGI that's used to calculate whether you're above the threshold or not. Cash value life insurance also becomes more attractive. The investment growth in cash value life insurance is not subject to either the tax or the surtax. Index products often have downside protection, so if the stock market drops, generally you're guaranteed a 0% floor, so you maintain your basis. And the cash value can often be accessed. We do have another poll up next, which we'll put up for you. And this is the last one for my slides. We're just wondering how many of you understand the potential tax and investment benefits of cash value life insurance. All right. Thanks for answering that. So many of you didn't know there were any benefits. Some of you think the tax-free investment, tax-free buildup is attractive, and some say your advisors steer you away. So one of the things that we would like to do is certainly educate you on some of the values. That's one of the tools in our tool bag. How does OJM Group work with our clients? We have a multidisciplinary team of experts. In our group, we have CPAs, certified financial planners, attorneys, certified wealth managers. We like to really focus on tax planning, asset protection, investments, retirement planning, and we have a team of experts who each of us looks at these things in a different way, and then we get together and talk about what we think makes the most sense for our clients and how can we work together, which pieces of the puzzle fit for your own individualized plan. We try to take a focused approach to the tax planning, retirement insurance planning, and asset protection. And as well, we have those investment professionals who will advise you on the investment income with a definite eye on the tax impact of it. So one last poll, and then I'm going to show you how to contact us. please just let us know what's the next best step for you. Okay, thank you all for answering, and thanks for participating. I'm going to show you one last slide, which is how to contact OJM if you're interested in learning more about our services or having a free initial consult call with one of our principals. You see on the screen there, you can contact Kathy Allard at our toll-free number or email at kathy@ojmgroup.com. Certainly all of our information is also on our website, www.ojmgroup.com. And I now want to pass the reins to Jeffrey Siegel. Jeffrey's going to speak to you about online reviews. Jeffrey is the CEO of Medical Justice, a group that we at OJM have found to be very beneficial to many of our clients, and we've worked with them on some mutual clients in the past and enjoy working with them. So thank you for your time this evening, and we certainly appreciate your attendance.
Hey, welcome aboard, everyone. Thanks so much for making time tonight. Yesterday on the news, I saw a blurb explaining that a record number of Americans had actually renounced their U.S. citizenship and had moved elsewhere, and I was wondering why. Having looked at the tax scenario for next year, I'm starting to understand, yeah, I get it. So anyway, I just want to make sure people can hear me. If we can just get a sign of life out there in the chat bar, that would help. Looking for a sign of life. Got a sign of life. Perfect. All right, let's jump in. What I want to talk about tonight would be doctor reviews, and something that I couldn't have imagined that even existed 5 years ago, but right now they're prevalent, and I have a perspective. I work in an organization called Medical Justice, and we've been at the vanguard at least thinking about how doctor reviews affect a particular practice. I am the founder of Medical Justice. We've been providing services primarily to keep doctors from being sued for frivolous reasons over the past 10 years, and now we're focused on helping to protect and preserve a doctor's most valuable asset, namely his or her reputation. So why don't we dive in? I'm going to start with a poll question, and this is going to be new territory for me playing with this poll, but let me see if I can make this work properly. So the poll must be closed to enable sharing. So jump right in. Have you Googled your name at any point in the past? It's a simple yes, no. I want to sing the tone for Jeopardy in the background. So we'll share the results. Looks like 63% have Googled their name, 38% have not. It's something that is so simple to do. We highly recommend that that people do this. All right. The list of doctor review sites is large and is getting larger. We count approximately 60 review sites that are out there right now, adding about one per month. Some of the names sound familiar, like Yelp and Angie's List. Some you may not have heard of, like Ripoff Report. As the name sounds, you probably do not want to be on Ripoff Report. So let's jump in with yet another poll question. Do you have a negative review? Have you have you had a negative review? Negative review. Not an uncommon phenomena. Negative reviews abound. We've published papers on this suggesting that some of the people who are posting are the most unhappy. And this is a sign of the democratization of the world, with the internet making it very easy. Anyone with a grudge and a broadband connection is certainly able to make their voice heard. So anyway, the question is, can you rely on this? And I like to fall back on a statement made by Mark Twain because I think it's relevant to online doctor reviews. He said, if you don't read a newspaper, you are uninformed. Oops. He said, if you do read a newspaper, you are misinformed. The thinking being that the information out there may not be entirely accurate, and the question is, can people reasonably rely upon this information to make life and death decisions? It's pretty clear the internet is not going anywhere. As I noted, we count at least 60 sites with a new site coming online every month. Interestingly enough, in the travel world, there's a go-to site named TripAdvisor. In the restaurant world, it's Yelp or Zagat. But in healthcare, no one site quite yet is perceived as the go-to site. More on that later. So the question is, are these sites even useful? And here's a prototypical review written on one of the sites. They use the sophisticated metric of a smiley face, although here you see a frowny face. Hitler should have burned this doctor, then I wouldn't have to deal with this scum doctor. I would argue that seems a little harsh to me, but you be the judge. There are various notes that have been sent to doctors that we take care of. If I don't receive $5 grand within 10 days, I'll notify all these sites, American Board of Plastic Surgery, the State Board of Medicine, and 10 physician rating sites. Yes, the world has changed. So what are some of the problems with the rating sites? And we'll talk about some of the solutions. Well, first, the majority of posts that are out there are anonymous. You can't really tell if they're written by a patient or someone posing as a patient. Well, who would pose as a patient? It could be a disgruntled employee, an ex-spouse, a competitor. We've seen it all. Next, everyone talks about Wikipedia, wisdom of the crowds, but for the most part on the doctor review sites, the average doctor has 0 to 3 reviews. You typically see anywhere from 1 to 2,000 patients a year. So if there's a wisdom of the crowds, there is no crowd. Next, because of HIPAA, doctors can't respond. If the Ritz-Carlton gets a rotten review, they can write back, but a doctor is foreclosed because of state and federal privacy laws from responding. Half a story, the status quo is that 2 days after surgery my wound opened up. Certainly not a positive review. But if you could give the full story, which you can't, it might actually state 2 days after surgery, against medical advice, I went back to work digging ditches and then my wound opened up. The full story would be informative, but we obviously cannot post the full medical record onto the internet. Next, good medicine is not popular. I can't tell you the number of times I've heard in my practice what the patient wants, but it's not the right thing to do. Doc, my 5 refills for Percocet ran out. Doc, I want antibiotics for this viral infection. It is a long list. Doing the right thing won't necessarily earn you a collection of brownie points on the internet. All right, so how do you deal with rotten reviews that are online? So, question we're asked frequently, can I sue for defamation? And the short answer is generally not, and to the extent that you could, we would say don't do it. There's a federal law called the Communication Decency Act, which immunizes the rating sites from defamation. Now, you can, in theory, sue the person, the author who posted the review, but then you'd have to know who they are, and frequently they're anonymous. And to the extent there are ways to detect that, it brings us to the Barbra Streisand effect, which is you shouldn't do it. What is the Barbra Streisand effect? Well, a number of years ago, a website went up which had pictures of aerial views of coastal property in California. One of those views actually included the house of Barbra Streisand. and I think a total of 10 people had downloaded Barbara Streisand's aerial footage of her house. Well, she didn't like the fact that anyone could do that, so she first asked the webmaster to remove the photo. The webmaster said no. Then she sued the webmaster, and then as well as the photographer, and she lost. Barbara Streisand lost. More importantly, many people were aware of the lawsuit, and it became page 1 on a Google search. So instead of the 10 people who had an interest in looking at coastal property, you probably had hundreds of thousands of people who downloaded it. The point I'm trying to make is that sometimes filing a lawsuit can take a non-descriptive review and turn it into page 1 news. We recommend against it. So the Internet actually has many positive features as it relates to doctors' practices. I took the liberty of doing a search for pizza when I was in Boston, and you can see on the map that there are a number of eateries downtown. Google assumes you're downtown and are looking for pizza downtown. But interestingly enough, you see the pushpin item number F, which is by the airport. And so the question is, what's going on with pizza place number F? So again, bigger view, blow-up view. Downtown Boston has all these pizza places, but pushpin F by the airport also has a pizza place Google is telling us we should see. Well, it turns out it's more reviews. You've got 66 reviews for Santarpio's Pizza by the airport, and most of the other places in downtown have fewer reviews. So Google places a great deal of credibility and authenticity to reviews, meaning that it's a good way to end up on page 1 of a Google search, certainly if you're pizza, and what we have found is if you're a doctor. So if I have a lot of reviews, I live in Greensboro, North Carolina, and if I've got more reviews than most other neurosurgeons in my community, and someone types in neurosurgeon Greensboro, if I have the most reviews, then I should be on page 1 of that search. Certainly a valuable piece of real estate. So our organization's put together full reputation management, which is the eMerit program, and it consists of 3 core subprograms. One is to monitor, know what is being said about you, and we've got a robot that goes out to look at your name on 25 doctor rating sites, and to the extent there's a new rating, that information is shipped as an email to the doctor. Number 2 is to respond. I did say it was very difficult to respond, but it's not impossible. There are ways to respond in a HIPAA-compliant way, particularly if the post is anonymous. Doesn't mean you're going to be putting up protected health information, but there are ways to turn a negative into a positive. And then finally, promote, which is, I think, the program that we're most excited about, which is we were initially skeptical of any type of review, but given the fact that the reviews can promote a practice, we said, why not ask the opinions of people who like you, namely your patients. We give your patients an iPad in the office, and they fill out a short survey. Survey results goes to the doctor, but those results also get uploaded to the various doctor review sites on the Internet. We say take advantage of your patients while they're in the exam room, while they're in the waiting room. Most of your patients, we have found over time, actually like you. Doesn't mean we're going to be able to do anything about the disgruntled individual at home, but to the extent you have an audience that is willing to participate, and it's voluntary, of course, we say, why not take advantage of that dynamic? Some of the things we've learned over time is that not everything you need to worry about. Don't sweat over every post, particularly if it's a negative post. You can go to the Ritz-Carlton website and look at some of the reviews that are there, and although most are positive, not all are. In particular, the Ritz-Carlton in Montreal, where all the U.S. taxpayers will be fleeing to shortly. So an occasional negative review is not really considered a problem, at least not from my perspective. If the review looks particularly unsophisticated, you don't need to respond. The public is cognizant of that. They will discount it. You can usually, not always, but usually ignore it. If it looks like a third grader wrote the material, you probably do not need to get into the gutter and respond, you certainly don't need to worry about it. Plan ahead. We talked a little bit about getting reviews from your patients, particularly if you make it easy for them to give a review. And the study was performed not too long ago in The Economist, in The Economist, which said that having an occasional negative review amongst a sea of positive reviews is okay. It makes the positive reviews look particularly credible. So having only positives is good. Interestingly enough, having an occasional negative amongst many positives is perceived as even better. Put in the tabular matrix, what I'm saying, that a single negative when one person has the megaphone, not so good, that's pretty bad. Better is only positives, but that's perceived as mostly marketing-like material. The best situation, which is how the audience or the public perceives this as being credible and authentic, is having mostly positive with an occasional negative. So here's an interesting study that was just released a couple of months ago, which looked at 7 years of data, 52,000 adults, so a lot of data, and they did patient satisfaction surveys. So what did they find? They found that the most satisfied patients actually had a decreased likelihood of going to the emergency room. So I think we can all agree that's a positive outcome. But they also had a higher odds of being admitted to the hospital. Not so good. And most interestingly, the most satisfied patients had a higher mortality rate. Now, that to me suggests that there's a disconnect between patient experience, or the customer service component, and clinical outcomes and patient safety. Put into tabular form, this is the graph that I excised from the paper, found that the most satisfied patients, category number 4, were 1.26 times as likely to die as the least satisfied patients. And so one question was, well, of course that's the case, because the most satisfied patients are the sickest patients, and they're the ones seeing the doctor the most, and they love their doctor. The doctors can't cure everything. Hence, the most satisfied patients have underlying conditions which make it more likely that they'll die. But wait, not so fast. The people who were analyzing the data excluded patients with self-rated bad health and all these chronic diseases. So they took out the people that may be headed towards a higher mortality scenario. And what did they learn? Well, the most satisfied patients were 44% more likely to die. So there's an interesting dynamic, and it's still, the jury is still out as to whether patient satisfaction is the end-all and be-all. Certainly the federal government believes that Medicare payment in the future should take into account patient satisfaction. But I would argue that patient safety and clinical outcomes should certainly be as important, perhaps a lot more important. So putting this all together, doctor reviews are here to stay. The internet is here to stay. I think to the extent that the dynamics out there, take advantage of it. The patients have responded very positively to doctors interacting with them by giving them an iPad, for example, to take a patient survey. We have found that patients not only like their doctors, indeed, we think they love their doctors. And given that it's challenging to practice medicine in 2012, I want to remind everyone that the vast majority of patients really do like what you do, and they are appreciative. So with that, let me pause to take a break, and I think it may be a good time to try and pose some questions. All right, I'm passing the baton back. All right. Any questions out there about the world of online reviews? To the extent you have one, you can put it into the chat functionality, if that's correct. I hear some noise in the background here.
Jeff, you do have a question in there. Someone asked if there's a way to respond, to be HIPAA compliant and respond.
Right. So the question is, can you respond to reviews and still be HIPAA compliant? And the short answer is it depends. So let me give an example. Patient writes anonymously that I went to see Dr. Siegel. The person at the front desk was rude, didn't respond, and my bill was twice what I'd expected. And that's a customer service issue. It's anonymous, so there is a way to jump in. There's a way to respond stating what your policy is related to billing, collecting. It may be that the person in your front office was only there for 2 weeks and is not working there any longer. And I would say take advantage of that dynamic. Go ahead and post that. You've not put it on any, you've not exposed any protected health information which would put you in harm's way as it relates to HIPAA. Sometimes a patient will write anonymously that they had a particular procedure and it didn't go well, and the doctor never saw you in follow-up. And if your policy is to see every patient in follow-up, again, if it's written anonymously, you can write, hey, look, our typical office policy for all patients is to see post office at 7 days and 3 weeks. If you have genuine concerns, I invite you to come to the office for a private consultation, because federal law prevents us from having this discussion in public. So the short answer is it depends. I think doctors need to be very cognizant of HIPAA. It is a false conclusion to believe that if a patient has posted information publicly that they have waived HIPAA. They have not. We've posed that question directly to Health and Human Services, and they state that if the patient's name is on there and they do a tell-all of their medical history, that doesn't give you permission to post online. So the short answer is it depends. Any other questions, comments, criticisms?
Yeah, there was also a question about what's the best way to terminate patients. You know, should you do it? Let's see, it says, should you do it specifics or not in a termination letter if you're terminating a patient?
Right. So I'm going to assume that when we talk about terminating patients, we're talking about terminating the doctor-patient relationship as opposed to terminating the patient. So we generally have a template that we give out to doctors when they want to terminate the doctor-patient relationship. It's fairly standard. You don't want to terminate in the middle of treatment unless you've got a follow-up plan for the patient. So if you've completed a particular treatment plan on a patient and it's just not a good match, there's a form letter you send out which says that I'm terminating the doctor-patient relationship. Having said that, I remain ready, willing, and able to take care of you for urgent or emergent conditions for 30 days or until you find another doctor, whichever comes first. You can find a doctor from the county medical society. So that's if you know, treatment is for the most part terminated. You're not in the middle of having done something, and it's just not a good fit for any number of reasons. It could be that there's a personality clash. It could be that the patient's not compliant. There are times we use language to try and soften the blow, if you will, to keep something from escalating, particularly if the patient has been non-compliant. So language, we think, does matter, but in terms of what you need to tell the patient, you just need to define that the doctor-patient relationship is over, and that you don't want to be seen as abandoning your patient. So you want to make sure that you're available for urgent or emergent care for a reasonable period of time, which is typically 30 days, or until the patient can find another doctor. Finally, you want to give them at least a general option on how to find another doctor, which is typically, you can call the county medical society for the names of available doctors. Any other questions?
Jeff, there are a few questions. If you'd like to take a few more.
I'd be delighted to. I cannot see.
All right. Well, I can. Let me just relay a few of them here to you.
Yeah.
One of the questions. Let's see. Let's see. One of the questions was, why do I have FMLA forms, especially if no payment received?
Why do I have an Family Medical Leave Act? Is that FMLA?
Yes.
Act, if no payment received. I plead ignorance, have no idea. No idea.
Okay.
Very satisfying answer.
We have another question here. It said, is a negative report a valid reason to terminate the patient-doctor relationship?
It's actually a great question. Is the negative report a reason to terminate doctor-patient relationship? The answer is maybe. It may. I mean, if you know who the patient, more often than not, you don't know who the patient is. But if you can really figure out who the patient is, I would first think about trying to get the patient back into the office. If it's fairly acute and the patient is just posted, I would use it as a reason to reach out to the patient and see what it is that they are unhappy about. You may already know the answer. But if this comes as a surprise to you, I would look at it almost as if they called your office and say, hey, look, we were on the internet, we found a review, I think it's you, I'd like to talk about some of your concerns. Most patients respond positively to that overture. When they post and they're unhappy, it's because they feel as if they haven't been listened to. So I'd use it more often than not as an opportunity to try and get the patient's attention, engage in a dialogue, preferably in person, face-to-face, and then you can say, look, if this is really how you feel, I get it, you're entitled to your opinion, but given that we've talked, I hope to be able to resolve the issue with you, and to the extent you believe it's resolved, I'd like to ask you to remove it. It's a request, not a demand. And when you couch it in those terms, we've seen that 95% of the times the patient will agree. They'll either remove it or they'll post something else which says that they achieve resolution of their concerns to mutual satisfaction.
Okay. And I missed the last question that you made. Did you answer the one about when you have patients do online reviews in the office on an iPad? This person was wondering if you're having them go to a specific site, such as healthgrades.com, vitals.com, etc.
Yeah, we've got a program, it's called the eMerit program, where the iPad actually goes to our system, and then our system uploads it to the various sites. It uploads to 8 different sites, such as HealthGrades, Vitals, Google, Insider pages, etc. So we call it an application for crowdsourcing, but it's a program that we've promoted. If people are interested, I invite you to go to the website emerit.biz. That's emerit.biz, and we can get you much more information on that.
Okay, and I think we have one more here. And stop me if this is one that Carole gave to you, but can you give an example of a HIPAA compliant way to respond to a complaint?
Right. So if it's a general complaint about your office issue, you can talk about your office. So you're not giving anything related to protected health information. The easiest ways to respond in a HIPAA compliant way would be to first identify that there's no protected health information that can be exposed. So, A, the person hasn't given their name, doesn't have their picture, so you can't identify on the surface that the person posting is even a patient. Number two, you're not really talking about specifics of the case. So it's more talking about your general office philosophy of how you deal with patients. To the extent someone wants to talk about specifics, you really got to bring them into the office. And I would state that I'd welcome the opportunity to speak with you. I can't do it in public. I want to talk to you in private. Please call the office at your earliest convenience.
I believe that's all we have time for today.
Thank you so much, everyone.